Justin said, one of the big things that we do is tax planning. We do a lot with investing, helping people get out of debt, helping entrepreneurs, make and save more money so that they can start going from business owners to investors. But a big part of what we do is also tax planning and filing. And some of what I want to cover today is just some practical things that I think will help with anybody that's on this webinar. I understand there's a wide variety of people on Justin's team with Plexus, people that are successful and have been doing this for a while, people that are up and running, people that are just getting started. So this information will kind of apply to everybody. And it's stuff that we can use right away. There's also an infographic that I'm going to go over, and I'll send this to Justin after the call. So if anyone wants to get a copy of the infographic, you can keep that and kind of use that as well. But the big thing here I want to cover is taxes, right? So we're coming up on tax filing season. And so as entrepreneurs and business owners, sometimes that can be a good thing. I remember for me, when I was a brand new business owner, that was a very confusing and scary thing because I didn't know what that meant. I didn't know what records I should be keeping. I didn't know what documents I should have. I didn't know what was deductible, what wasn't deductible. And so part of my intention today and my aim today is to provide some answers there and help simplify things a little bit more, right? So for those of us that are on this call right now, we're some kind of business owner. We are some kind of entrepreneur, business owner, self-employed person. And what that means is for all of us, whether we've got a team, we're experienced at this, we're brand new, it means that we have the opportunity to create our own income. We have the opportunity to run our own businesses. We have the opportunity to spend our own money in order to grow and expand our businesses. And that's kind of where all this starts. Now, what I'm going to do is share my screen really quick. I want to show everyone this infographic so we can kind of go over this together. Okay. So as a business owner, it's important to understand the rules that we're playing by, right? And for a lot of us, the reason why we are business owners and entrepreneurs is because at one point we started to understand the rules that income plays by. We can be an employee, we can be self-employed, we can be a business owner, we can be an investor. And a lot of us took that jump from employee to becoming self-employed and becoming a business owner. So similarly with taxes, there are rules and there's different categories that apply, right? Now, those rules are part of something called the tax code. And I like to hit this first because this is really the first point to understand. There literally is a code where all of our tax laws are written, okay? It's passed into law by Congress. And that code, as you can see on the infographic here, it's over 5,000 pages in length, okay? So if you were to take every single page of the tax code and line them up in real life, back to back to back to back to back in a room, if you were to fire a bullet through one side of it, it would not get through the other side because there's that many pages, right? So with that, to kind of get some reality, that can be a little bit confusing. 5,000 pages is a lot of things to know about, to remember. Not only that, they're always changing it and updating it. Almost every single year, we get new additions and new changes to the tax code. But it's important to understand that there is one, and it's important to understand that everything that applies to taxes can be found in the tax code. Okay. Now, as the infographic says here, and this is one that kind of gets confused, I think sometimes, is there's not actually such a thing as a tax loophole, right? There are things that are legal in the tax code. There are things that are illegal in the tax code. And so we can often, come into things that are in the tax code that we might not have known about before and consider those tax loopholes. They're actually open and available for all of us to use. Right. We just have to understand what's there. I like to relate this to, if I were to, let's say I were to go to court, me representing myself, not knowing the law versus me having an attorney who does know the law, right? If I don't know the law and I'm representing myself, it's going to seem like everything is magic and everything is this loophole and it's this secret rule. Really, it's just the difference between me knowing what's there and not knowing what's there. Right. So I definitely like to recommend, understand some of the tax code. It doesn't mean you've got to study it and memorize it, but be aware that there is one and also utilize it. You can go online. You can actually find the tax code on the Internal Revenue Service's website. Cornell also has a copy of the tax code. And so anytime personally that I have a question where I'm like, hey, is this legal? Is this not legal? What can I do here? I'll actually go see what the tax code says. Right? Sometimes I'll totally understand it. Sometimes it gives me enough information to get my footing and be able to start asking good questions of my tax professionals, right? And then they can clarify it. But that little bit of data that I can get from the tax code gives me enough certainty to actually be in control of things, versus me not knowing. I don't know if you guys have ever experienced where something is so new and so foreign, you don't even know what to Google. Like you don't even know what question to start asking. Taxes can be that way. So this is a way to solve that. Now, what's funny about the tax code is, like I said, it's over 5,000 pages long. Only about 0.05% of it actually pertains to the paying of income tax, right? Only about 0.05% of it. That's a very small amount, right? That means that the rest of it, 99.95% of the tax code actually addresses ways to not pay taxes. Okay, a lot of us don't know that. We think about taxes, we think about the IRS, we think about the tax code. And like I said, for me, that was like an area of fear and confusion, because it was kind of like, the mafia. I don't want to do anything wrong. I have them come to my house with a duffel bag and baseball bats, right? Like the IRS is kind of that with business owners. And so if you understand, a lot of this is geared to reduce taxes. A lot of it is either, there's kind of two sides to this. It's either, the tax code gets put into play by business owners and corporations who didn't want to pay taxes. And so they actually hire lawyers to write laws, and then they lobby those laws in with Congress, and then those laws get passed as bills. So those can be areas of the tax code that are actually written by people like us, corporations and business owners, that said, hey, we don't want to pay taxes on X, Y, and Z, and we've got enough money to lobby this into being part of the tax code. So there's a lot of it that it's stuff we would want to use anyways. We've just got to know about it. The other side of the tax code is created by our government, and it's incentives, right? The government will incentivize us to do certain things because it's good for the overall economy, or it's good for the overall country. And by doing those things, they'll give us tax deductions and they'll give us tax credits, right? And so there's kind of two different sides we can drive with. We can look at what are the natural incentives that a business owner would want to have, and we can find those laws and those rules in the tax code. And then we can also look at what does the government want us to do? What benefits the country and the economy? We can find those things in the tax code as well. And if we keep that mindset, it makes taxes a lot easier, and it makes it a lot less scary. Okay. Now, on this part, like, we've got to realize also what is being taxed. So if I'm a business owner, and I'm going to actually draw this out, if I'm a business owner, I've got to understand some of my own accounting and some of my own bookkeeping. All of us should be doing this on some level. If I'm brand new, I need to understand the difference between my sales, right, and then my profit. So sales, this is going to be my commissions. What am I earning on my top line, right? And then I might have costs of product, right? So I have these are called costs of goods sold. I might also have operating costs. I might also have payroll and different things that I spend money on. And then after I've spent all that money, at the bottom, I'm going to have profit. Okay, the IRS only wants to look at your profit. This is what they're taxing. So if I'm in Plexus and I sell a product and I make income, that's great. I've earned a commission, right? Now, the difference between my commission, which is my gross sales, my gross revenue, and my profit that I'm actually going to pay my taxes on is, what am I deducting as cost of goods? What am I deducting on my operating expenses? What am I deducting on payroll? And different things in those categories, right? As an entrepreneur, we don't always get taught this. So I remember my first year in business, I was scared because I sold and I had income. I didn't know what I could deduct and what I couldn't deduct. And so when I went to go calculate my taxes, I realized I have this giant tax bill. Maybe that's happened to some of us. When we start to get around that 6-figure mark, it's kind of the sweet spot for having that alarmingly high tax bill, right? So part of this is having good bookkeeping and good administration to understand throughout the year, what is my actual tax liability? What are my profits on a monthly basis, on a year-to-date basis, so that I can start to analyze and predict and know ahead of time, based on what I'm showing on this profit number, here's about what I think I'm going to owe in taxes. Okay, I missed this early on in business. One of the things we teach our clients on this is when we track this, it prevents two things from happening. The first thing that can happen is we end up unprepared. At the end of the year, we have this giant tax bill. We're scared. We don't know how we're going to pay it. Or the flip side of that, I've also seen business owners trying to defend against this by setting aside like copious amounts of income for taxes, right? They'll set aside 25, 30% for taxes kind of arbitrarily because they don't actually know what the number is going to be. That's better than owing and not having the money to pay up. But the sweet spot is actually to know the number. And this is how we know the number. We can actually track that number through knowing what our profits are. And then we just set aside what we know we're going to need. And then the rest of it can go back to our business and our families and whatever else we're trying to do with that income. Okay. So that's kind of the first point, is understanding that tax code and really understanding why it's there, what it's for, what it's meant to do, and really being able to then utilize it. Now, the next one here is self-employment activity. I love coaching business owners on this one, self-employment activity. Everybody on this call, like I said, has some form of self-employment status just by being a representative with Plexus, right? So just that affiliation, it gives you the opportunity to say, hey, I'm self-employed. Right now, within that, there are different degrees of how active I can be with that self-employment income and with those self-employment activities. An example might be if I'm part-time and I just show up once or twice a week and I do some meetings and I do some things here and there, and it's really not a full-time thing yet, I've got self-employment activity to that extent. Right now, what I might miss is that even though I'm not running this business like a full-time thing, I should have a home office. I call this living in your business, this self-employment activity. How can we bleed this into other areas of our lives and get more deductions? So I can have a home office. I can be paying my kids. I can be writing off meals. I can be writing off entertainment. I can be writing off travel, right? I can be writing off education and self-development. So there's so many things that as an entrepreneur, if I've got that entrepreneurial pulse, I'm probably going to be spending money on anyways, regardless of whether I'm in Plexus or whatever. It's going to be just things I do in my life. And by quote unquote living in my business, I can take those things that I was going to do anyways, make sure that on paper and in real life, they're affiliated with this self-employment activity, and then be able to increase my deductions. Okay. And by doing that, again, that lowers that profitability, that lowers that tax bill. And it's not new money that I'm spending at this point in time. We're really looking for old money. What was I spending already that wasn't associated with my business that could be legally, and it could be documented as such so that it reduces my taxable income? Okay. So on this note here, I put here, entrepreneurs, we really do have the number one tax advantage per the tax code. It's very hard to get the same deductions as a self-employed person, as a business owner versus somebody that's just a W-2 employee. Right. Like when I do tax returns and we help our clients with this, I almost feel bad for the people that are only W-2 because they're missing out on so many opportunities to write off stuff that the self-employed person has. Okay. So in order to take advantage of these, there's a couple of things we've got to have in place. We do have to have a business, right? So if you're in Plexus, you automatically qualify. You have a business, you've got an opportunity, you've got self-employment activity. Second thing is you need to have an entity set up. An entity means an LLC or a corporation. Okay. Now, technically you can get away without one, but when you look at IRS case history, they typically are a lot harder on people that are writing off business expenses as a sole proprietor. If I do those same business expenses, but I route them through an LLC, the IRS is going to be a lot more lenient because there's a clear separation, right? That LLC, it's got its own tax ID number. It's got its own bank accounts. It's got its own records. And so it draws a very clear line for the tax man to look at and say, okay, that's Jerry's company that's spending that money, not just Jerry trying to write it off through his company, right? So that's a good protection barrier. Obviously being active in the business. So you do need to have some sort of activity, whether that means that you're prospecting, you're looking for referrals, you're going on calls like this, right? If I'm on this call right now, I'm going to be at a restaurant or a coffee shop that I was going to go to anyway, so that I can say I'm doing personal development and I'm having a business meal and I'm writing off my dinner tonight, right? Like those are the kind of things we should be thinking about. So we have to be active in the business. We do have to have an intention to earn income. Okay, now that's something that is kind of on the honor system. Like nobody can measure our intention, but you know if you intend to earn income. If you're here and you're like, my goal really is to have a business, not just find a way to write off a bunch of stuff. And I don't think that that's probably most people on this call where it's like, I'm not really interested in business. It's for write-offs. Like a lot of us really do want to grow our businesses here. So having that intention is good. And the best way to measure that intention is through record keeping. Right? Like we were talking about with the meal. If I'm writing off the meal tonight because I'm at Panera Bread watching this webinar and I'm having a sandwich and I'm gonna write that off as a business expense, right? I'm gonna document that I was on this call. I'm gonna keep the receipt from Panera Bread. I'm gonna make sure that I have that in my files, whether I take a picture of it or I put it in Excel, and I'm gonna notate what I was doing and how it was related to my business. I might even drop off a business card with the front desk lady to say, hey, I was also prospecting. right? So that's what it looks like to be able to prove your intention and really measure that with deductions. And then obviously we've got to earn income at some point. We can't just always lose money forever. So that's another part of really measuring that intention. If for 10 years in a row, I'm showing a loss on my business, at some point, the IRS is going to be like, Jerry, how are you still in business, man? It's been 10 years. You've never shown a profit. Every year we get a loss from you on your tax return. So again, that's another true measurement of intention. And then finally, it comes down to having deductible business expenses, having a home office, having expenses that can prove that I am out there working the business, even if I'm not good at it yet. I might lose money the first 3 years or the first 4 years. I might not make a profit at all. For me, in my business, I wasn't profitable for 3 or 4 years. Okay. I was a part-timer that got started up, and then I slowly built it up to the point where it was full-time for me. But I still did have those business activities. And what I want to stress here is a lot of times for us just starting out, it's easy to invalidate those because we haven't made money yet, or we haven't gotten to where we want to be yet. And technically, yeah, we went and we did something with our business, but we're not going to track it and we're not going to write it off because we haven't gotten where we want to go yet. The IRS doesn't care about that. They care about, did you actually spend it and what does the record show? Okay. So really be honest with this, be accurate with it. But the thing that I like to stress on having this, and we're going to kind of transition into the bookkeeping, is being honest on our taxes, right? Like think about if I had income show up in my pocket that I knew was taxable, but I lied about it and said it wasn't. We all know that that's clearly a violation of the tax code. We would never do that. Right. But on the flip side, if I spent money that was associated with my business and I knew it was, but I didn't tell the IRS, that's no different. That's also lying on my taxes. I don't get any financial benefit for doing that. Like I end up paying more in taxes, but it still was a business expense. And I should have the same level of integrity with writing off my expenses as I have with reporting my income, because those are both real life transactions that did happen. Right. So those are important to look at. Now, the third component, and this is the one I want to spend some time on. This is where a lot of us miss out. Honestly, it took me years to get good at this, having accurate bookkeeping. Okay, accurate bookkeeping with my business, right? When I'm looking at my business, like I'm actually, I need to know my numbers and I need to be tracking those and I need to be reporting those, because that's my internal engine. My financials in my business are going to tell me how profitable I am, how well my team is doing, how much we're spending, how much we're keeping. I can look at different ratios and find out which marketing campaigns are working, because I can see when I spend X amount of money here, my profits go up or my revenues go up. So having this down on bookkeeping is important. Whether you're using QuickBooks or Xero or Keeper Tax or any of those do-it-yourself programs, I recommend everyone do this, even if you haven't made a sale yet, right? You're tracking those expenses still. So here's the thing with bookkeeping. We can easily reduce taxes, right? But at the end of the year, my CPA or my tax professional can only file what I can show them. So a lot of us, what happens, especially if we've been accustomed to doing our own taxes, we can kind of keep in our own minds, okay, I think I spent money here, I think I spent money there, and we can kind of get away with it. But the moment that you introduce a professional that's not in your head, they don't know what you spent money on or didn't. And so if I don't have bookkeeping and a profit and loss statement to be able to show them, this is really what's going on and this is really what I'm spending, this is an area for me that can interfere with my taxes because they don't know what's going on. Right? They're only able to help me file and plan with the data that I give them. So if there's missing data or there's data that is misconstrued or inaccurate or stuff that I just didn't even bother to report, that's going to be really hard for me to have a CPA or a tax professional be able to step in and help. Okay. So that's kind of the first degree of it. Those that have better documents and better records with their expenses and their income, they're going to have better opportunities for tax write-offs. Now, the second thing here, and this is for those of us that are maybe a little bit aggressive and we like to do our taxes ourselves, technically anything is deductible until the IRS calls our bluff, right? I can write off technically anything and get away with it till the IRS checks. It's like speeding, right? Nobody knows that I'm speeding until a cop sees me and they pull me over and they tell me how fast I was going. So in the tax world, if I'm not tracking my documents and having my bookkeeping done and my accounting done, if I were to ever get audited, the IRS is only going to let me keep those expenses that I've deducted that are actually tracked, right? So if I had, meals and entertainment and I say I spent $7,000 and in my own mind, I know I did, but I failed to keep bank records, or I failed to keep a profit and loss statement or transactions and receipts. If the IRS came and audited me, the first thing they're going to say is, Jerry, you need to produce records and documentation showing all of these expenses you took. And if I can't, they're going to say, that sucks, but you can't keep those on your taxes. So they're going to take them off. And then what happens is I end up owing money. Not only do I owe money, it's going to be for a prior year. So all of what I owe is now accruing penalties as if I had not paid those taxes that year. And that's how we end up with this big giant tax bill, right? So like accurate bookkeeping is so important. Now, the other one that's great about this is if you start doing your bookkeeping, again, QuickBooks or any of these programs at a very basic level can help. What this does for you as a business owner is it keeps you in control. Okay. So when you get into a position where you're making, 250, $500,000, $1 million a year in your business, and you've got other people producing and you're in more of a leadership role, the numbers tell the story. Right. And so if I've never done any bookkeeping and I've never done any accounting in my business, and I'm trying now to manage and lead, it's really hard to do that if that profit and loss to me looks like a foreign language. Okay. That's really the important part. Now, when I get to the level of then starting to invest and let other people come into my finances, this is another way to also make sure I'm not being stolen from. Okay. If I don't know what my numbers say, how do I know where the money is going? And this sounds like it's unrealistic, but I can tell you, I talked to a friend of mine he runs a multi-$100 million company. He said, yeah, a couple of years ago, we had a guy steal tens of millions of dollars from us. Embezzlement inside the company, right? Trusted employee. No one ever suspected it. And the way that someone gets away with that is because someone's not looking at the financials. Okay, because you're not tracking every receipt, and it wasn't $10 million all in one fell swoop. It was a little bit of money here and a little bit of money there. And it was just small enough for nobody to notice. But let me tell you what, if they looked at the bookkeeping and the accounting and they said, what's this expense? Let's find the receipt. Let's figure out what this was for. It's much easier to catch that and to stop it before it gets out of control. Because yeah, they catch the guy and he's wrong, but he probably doesn't have the $10 million anymore. So we can sue him and try and get it back, but it's gone. We're not going to get that money back from him. So this is really like a three-pronged, like the bookkeeping. It's going to be, again, helping your CPA, helping your tax team reduce your taxes. It's also helping you protect yourself from the IRS. Okay. If I've heard stories and seen people as well where the IRS audits them and their bookkeeping was so good that by the time the IRS was done, the IRS figured out that they actually still owe that person money. So they flipped it because the person had such good record keeping that the IRS was like, shoot, we actually owe you money. We didn't realize this, and you missed XYZ on your tax return. And they sent the person a refund check. Right. So it can help with that. And then third, it just helps you as an executive, as a leader in your business. So these are huge with bookkeeping. The fourth one is hiring a tax expert. Now I put this fourth because at the very bottom here, this is not a fix-all. Okay, a lot of times what I see happen is we get overwhelmed with taxes and accounting and bookkeeping. So we say, hey, we're going to hire a tax professional. And we think what that means is that we don't have to worry about any of this stuff anymore. It's now out of our lives. It's off our plates. Someone else is doing it. That's usually not the case. Okay, a tax person, what they're going to do is they're going to file your taxes. They're going to file it with the information that you've given them, right? And if you're not doing steps 1 through 3 on this of, again, understanding your tax code, being active in your business, managing your bookkeeping and your expenses, and knowing what's there, then that tax person, they're just going to take data and they're going to file it. And at the end of the day, whatever is there and whatever is not is not. They're not going to do quality control checking and come ask you if you were supposed to put in X, Y, or Z. Right. It's especially around tax season. It's so busy for a lot of these CPAs where they're doing 8 or 10 or 12 tax returns per day. Right. Think about when you've ever walked into like a busy Starbucks. They get the names wrong on the cup. Sometimes the order's not right. They're not bad intentioned. It's just that busy. Right. So the tax person, their job is not to say, hey, Jerry, your return looks a little bit like it's too high. And so we assume there might be some things you've missed. Let's go back and check. Most CPAs aren't going to say that, right? Our firm usually does. But even so, if I'm paying attention to my own numbers and they send me that tax return back and I see that it looks too high based on what my calculations said, then I can catch it. And I can say, hey guys, let's take another look at this because this seems like it's a lot higher than what I thought was there. right? Like these people are doing just the best job they can with the information and tools they have. So when we have steps 1 through 3 done, that's when it's really the right time to hire a CPA. Okay. And the right tax firm, they're also going to be proactive and not reactive. Okay. This is a part that, again, a lot of us don't know yet because no one teaches us this stuff. But if we're doing our tax planning in tax filing season, it's already too late. Right. And I'm going to sketch out what I mean by this, because there's a prime time and a prime way that we would go about handling tax planning versus tax filing. Right. So let's say if we were to look at this as in a calendar year, right? So we have January. This is kind of when like filing season starts. January, we start getting our 1099s and our W-2s and all of our different records and documents in. And then basically in April, this is where we file. If we file an extension, right, then we've got typically till October, like September or October, depending on what type of corporation or entity we have. And then essentially by the end of the year in December, the current tax year ends. Right? Now, this can be a little bit confusing because when we file taxes, like for example, in 2021, we're filing by this April, but we're actually filing for what happened in 2020. Right? So we've got old filings for the previous year going on, and then we've also got a brand new year that just started, and there's current income and current expenses and current tax planning that needs to take place in this current year. Okay? So when I'm thinking about, let's say in 2020, right? In 2020, I'm thinking about my taxes. All of my tax planning for 2020 should have been done before December. Any moves I was going to make, any investments I was going to do, any money I was going to spend on my business, all of my accounting and record keeping, all of that stuff should be done by December, right? If I'm waiting till after December and then, this year, 2021 happens and it's now January to April and it's filing season for my 2020 taxes. And I'm now thinking about things like, well, how do I reduce my tax bill? It's too late. There's two or three things I can do. I might be able to max out an IRA or a retirement account, but that's kind of it. Okay. Now this is for me, when I started learning about taxes, I learned this the hard way because I was like, man, why does it seem like I'm always overpaying? And then I realized, well, because I'm waiting till the tax year is already done. And so I can't go back and do any of these things. The cutoff happened and I had to do them before December 31st. So really, like for the tax planning side of things, for tax planning, yeah, in the previous year we're filing, but in January, we should be looking at in the current year proactively based on what I did last year. What do I think I'm going to make in 2021? I can only know that if I did my bookkeeping for last year. Right? If I don't have a profit and loss from 2020, it's going to be very difficult for me to look at 2021 and say, here's what I'm going to make. Right? So I should be looking at that in 2021 at the beginning of the year, starting to put together a proactive plan that I can then work throughout this year. Now, by October, I have a pretty good idea of how the year went, right? I've got 9-10 months of production in. I can look again at my profit and loss. So I got to be doing the bookkeeping. I can look at that profit and loss sheet for the current year-to-date numbers for 2021 in October and say, okay, here's what I have. Based on what I have, here's what I predict is going to happen between now and the end of December. What's my current tax liability look like? And what do I need to do before the end of this year to get rid of as much of that liability as I can? That's the ideal way we should be handling taxes. Okay. And then the year ends, December happens, 31st, we cross over into the next tax year. Now I file for this current year that I just finished in that tax season for 2022, before April, I've got to file for 2021. Right. So it's kind of this rolling forward. Every year I've got to be keeping track of the lane where I'm planning for the current year. And then I'm also filing for the previous year. And a lot of times we get those mixed up where we just think taxes and then we think taxes are being filed. What can I do to reduce them? And we miss out on a lot of things when that happens. Now, again, our CPAs and people that we might hire or work with our taxes, they're professionals. They've got great intentions, but their job is not to do that for you. Okay, that's the job of a tax planner. That's the job of a tax attorney. So I've got to realize if I'm hiring a tax person and I'm working with them, I need to understand, is that part of their job? That's actually a question I need to ask them. Okay, are you proactively helping me reduce my taxes, or are you just helping me file at the end of the year? The reason why is in business, if it doesn't get communicated, it's probably not going to happen, right? If I'm working with my downlines on something, my employees on something, if I don't tell them or ask them and there's not communication about it, I can't really be surprised when it doesn't happen the way that I hoped it would. So never leave anything up to chance. With taxes, I need to have that conversation, right? If you're working with a great tax team, they're going to say, yeah, we're going to sit down and look at this current year. We're going to reduce everything we can. At the end of the year, we're going to shore things up, see what's left over. We're going to get rid of it. And then yes, we'll file. But that's probably 95% of CPAs that don't do it that way. Okay. So this is really important to know on this point. And again, this is about hiring the right tax expert. Let me pull this infographic back up for you. Okay, so the right tax expert, they're going to be proactive, not reactive. They're going to be solution oriented and understand the risk versus reward when it comes to the tax code. Okay, what used to drive me crazy, and this is why we started our own tax firm in my company, is I hired a tax person. I was like, hey, can I do X, Y, and Z? And they're like, no, you can't. And then I'd be like, well, why? And they wouldn't really tell me why. They would just tell me I couldn't. And I've never been the guy that I can just take that answer and not figure out, well, why is that the answer? And how did we come to that conclusion? And are there workarounds and are there other options? So when I started looking, I started realizing that a lot of it just came from either my tax person, it wasn't their business. Like they weren't in the business of reducing taxes. They were just a Starbucks tax filing joint. They just wanted to pump out returns. That's fine if that's their model. Or it could also be that they didn't know. But when I started to research, I would find out that some of these questions that I was asking, there really were solutions. This goes back to point number one of understanding the tax code. When I started reading the tax code for myself, I realized, wow, I could actually deduct X, Y, and Z. My tax person said no. I don't know why they said no. It really doesn't matter why they said no, because the fact is that I can. Right. And so the right tax professional, when you ask them a question, they're not going to say no. They're going to say, let me check. Let me find out how that's possible. If it's not possible, they're going to be able to show you in the tax code where it says it's not possible. Okay. So there has to kind of be like this tension with you being the customer and the client with getting your taxes filed and also hiring a business where you have to be a little bit professionally and politely unreasonable. Always asking questions, always inquiring, always asking why. I can't tell you how many texts I get from Justin about, can we do this? Can we do that? And I love it because that means Justin is looking out for his taxes. Okay. So, and again, your taxes are not their taxes. They have 100, 200, 1,000 people. So there's not a lot of emotional attachment for them on if you paid too much. Their main thing is staying out of trouble with the IRS, getting the return done and getting paid. Right. But you're the one that feels it if the taxes are higher than they should have been. Or they were lower than they should have been, and the IRS comes looking and asks questions about it. You're the one that has to handle that. So proactive, not reactive. They have to be solution oriented, and then they have to understand risk versus reward. When I hire a tax person, and this is how my tax firm operates, we work for you, not the IRS. The IRS are the bad guys, right? So we're not on the IRS's side. A lot of tax people, they work for the IRS. Meaning that their mindset is we have to stay out of trouble and we don't want to take too much risk and we want to avoid audits. And those are all normal sounding things. However, an audit doesn't mean anything other than the IRS is calling my bluff. They're saying, let me see your cards. If I'm holding all the cards, they're going to leave me alone. Like I said, we've had it where they call to see our clients' cards. The people show them the cards and the IRS is like, shoot, we're sorry. We still owe you more money. So we shouldn't be looking at this as avoiding getting in trouble, avoiding taking risks, avoiding doing anything out of the ordinary. We should really be looking to use the entirety of the tax code, using it legally, and then documenting that it's being used correctly. And that's understanding the risk versus the reward. Any deduction we take potentially has risk, potentially could get audited. But at the end of the day, is it going to reduce taxes? Is it legal? Are we documenting it? Are we doing it correctly? And if so, then that should be a risk that your tax professional is willing to take with you. Okay, and that's a good question to ask them is if we get audited, what happens? Sometimes it's just, if I'm working with a single person shop, if they get audited, that would pull them off their business so badly that they couldn't service their other clients. And so they just stay totally away from anything that could potentially get them audited because they don't want that distraction. Right? So this is important. I know we spent a little more time on this one. The last point that I want to cover is, again, having a plan, right? We should have a plan to not pay taxes. There's nothing wrong with that. We already know our country runs on a federal budget deficit. We spend more than we make. So why do we keep feeding the beast? Let's see if we can lower the taxes and build more personal wealth and more freedom with that money instead. So the 3 cycles here on planning is, again, the beginning of the year is forecasting. I'm forecasting based on my last year's profit and loss. What am I projecting for this year? What do I think I'm going to make? Based on what I think I'm going to make, what am I potentially going to owe in taxes? And then what am I going to do proactively and preemptively to reduce that? That's all happening in this forecasting phase. Then we have mid-year implementation and monitoring. All those decisions we made at the beginning of the year, we're now implementing them. We're keeping a pulse on things. We're making sure that things are going well. We're having our monthly profit and losses done and looked at. And then finally, as I mentioned, is end of year planning, looking to reduce and eliminate the remaining of our tax bill. Okay, what's left over? How do we get rid of it? That happens at the end of the year, right? Now, this is important. A lot of people don't realize how much you can save on taxes. A good tax plan can reduce taxes by 50% or more. Okay, I can't tell you how many clients we've had 6-figure tax bill reductions. Like they were going to pay, high 6 figures in taxes or multiple 6 figures in taxes. And we cut it in half, or we cut it by 75%. Sometimes we even cut it to zero, right? Like Justin's an example of someone we've been able to do a lot of tax reduction with because of the fact that he's a business owner and he's doing a lot of these things. He's reducing his taxes. He's doing his profit and loss. He's got his records in order. So that's kind of our ideal client. We love that we can help someone with that. And so that really is the return on investment. Is at the end of the day, if I don't do this, I will pay the tax. I will owe the tax. So that's a guaranteed expense. And if I can get a plan in place that lowers it by 50%, let's say I'm going to pay $100,000 in taxes. I hire a CPA, they cost me $10,000, but they save me 50% of my tax bill. That's a $50,000 return on investment. I spent 10 and made 50 by reducing those taxes. So these are the main points. I know we covered a lot in a very short span of time, but this is just an area that I think everyone should know about. Everyone should kind of have some information and some expertise on. Everyone should be constantly learning about. Again, this is not individual tax advice. These are very general statements. So everyone's tax situation is going to look a little bit different, but these are all basic things we all can and should be doing. And if we all do these things, we will all end up with lower taxes, and business is going to be a lot more fun and a lot less stressful. So what I want to do here is I want to open this up for questions. I know we have a couple here in the chat. So if you have questions, go ahead and drop these in the chat. And what I'll do is I'll go ahead and answer some of these. And Justin, feel free to jump in anytime as well if you've got questions or specific topics that would be helpful.
Okay.
So we have a question from Molly on bookkeeping for network marketing. So she says, which program is good for bookkeeping for network marketing? So with bookkeeping, QuickBooks is great. So depending on the size of your business, there's going to be different types of programs that are beneficial. So if I've got a pretty good sized business, QuickBooks is great because they're going to be able to integrate and do a lot of different things. There's another one called Xero. I believe that's spelled Xero, similar to QuickBooks. There's one that I really like. If I'm brand new and it's like I started last week or last year and I'm not quite up where my business is pumping out tons of revenue and transactions yet, there's a program called Keeper Tax. Okay, Keeper Tax. And what that is that's kind of an automated self-employment app. So if I've got a smaller business, not a ton of transactions, that's an app that I can link all my bank accounts to, and it'll actually kind of track and categorize things for me. And it's very inexpensive. I think it might be, $15-20 a month to do that. So those are kind of the three that I like. Again, if you're a bigger business, I like QuickBooks. If you're smaller or just yourself, Keeper Tax is a great option. Let's see here. Question here. Can a teenager generally be able to handle the bookkeeping? Potentially. Yeah. I mean, it definitely is something you want to give oversight, but if you have a teenager or a kid, Justin, for example, has some sons, he's got a daughter that are around the age where they could be helping with this stuff. So if they've got a knack for numbers and you're okay and you trust them with that and you're going to oversee it, because if you get audited, you can't blame it on your 13-year-old, right? The IRS really doesn't care. But if you're tracking those things, then I think that could be helpful. Especially if it's a family business. I think that's a great way to get your kids involved, help them start seeing, the numbers behind the business, how it works, how important production is, how important it is to be tracking expenses and all those types of things. Justin likes QuickBooks. Yeah, QuickBooks is easy. Like the bookkeeping thing, it sounds like it's a beast. It's really not. It's addition and subtraction at the end of the day. The apps, a lot of them can link to your accounts. They can import your transactions. They add the totals up automatically for you. It's really just about categorizing them correctly. So it's very easy to jump on a program like that and get started with bookkeeping.
One thing I'm going to add real quick on QuickBooks, like Jerry said, you can link that to your bank account. So basically what happens is all the transactions that happens on your bank account, whether it's a deposit from Plexus or an expense, if you're putting fuel in your car to go to an event, whatever, that all goes to your QuickBooks account. And you're basically, all you're doing is approving, and you're putting it in a category like fuel, food, whatever you're putting it into, products, or what you're advertising, promotion, whatever it is. So it's really simple. And you can actually, whoever your tax professional is, you can make them a manager on QuickBooks Online. So they can even go in and make sure you're doing stuff throughout the year if you want something like that done. So it's really nice. I ran 1099s off of my QuickBooks today. I'm a little late, don't judge me. But you know, it's a really great tool, and you know where you're at. If you're doing it, you know where you're at any time of the year financially as far as your business goes. It's a great tool.
Yeah. One thing I'll add to that too, with bookkeeping, frequency is so important, right? It's kind of like not folding your laundry or not doing the dishes. The longer you wait, the more you dread doing it, versus if I log in weekly and I manage my QuickBooks, then I'm going to spend 15 or 20 minutes on there at a time. And it becomes a super easy task, versus even if I'm waiting till the end of the month, if I've got a business where I'm doing 200 or 300 transactions, that's a lot. That's a pile. And it's going to be something that I don't look forward to doing. So log in frequently and try and like manage it and keep it down as low as you can so that everything gets categorized very often. So Molly has a question. Molly Schultz asks, at what income level should I incorporate? This is a very good question. So there's not a one size fits all answer to this, but there is a method. And so I'm going to show you what the method on this looks like. Okay. Now, another thing as a business owner that I didn't know about is something called self-employment tax. Okay. Anyone that's had profit here understands the pain and the burden of self-employment tax. So when we earn income, when we have profits, we pay federal income tax. We all understand that. We pay state income tax. We all understand that. When we were employees, we had on our paychecks, payroll taxes. Our employers would cover payroll taxes, which go for Medicare and Social Security. Now, if I have not got an employer and I am the employer, meaning I'm self-employed, then I have to pay those taxes myself. So that's a third level of tax we're going to pay. We're going to pay state, federal, and self-employment. Usually that self-employment tax is going to come out to around 15% on top of those other taxes. Okay. Now, this is only on profits, right? So we talked at the very beginning, we have income and then we have expenses, and what's left over is our profits. And that's the only thing the IRS can tax. So incorporating, so if I'm a self-employed person, like I said, I'm going to pay these self-employment taxes. If I incorporate, I can reduce them. So this means that I'm going to set up an S corporation, or I'm going to elect to file as an S corporation via my LLC. Okay. The idea behind this is, as a corporation, I can pay myself on salary, and that salary will have the self-employment tax, but anything beyond that salary, I can pay myself as a distribution because I'm an owner and I'm a shareholder in my S corporation. Those distribution payments do not have self-employment taxes. Right? So again, there's not a hard and fast rule on this, but the rule on the salary is it has to be commensurate pay, meaning it has to be like reasonable within the industry average for the position that I'm in. Right? So if I'm a business owner in Plexus, what I could do on my S corporation is I could go on payscale.com. I could find out how much does a regional sales director at Vitamin Shop or GNC make in salary. And that's my base salary. Right? That might be 40 or 50,000. If I get audited, I can tell the IRS, hey, this is normal pay. You can check online. This is where I got it from. But everything beyond that salaried number. So if I make 600 grand total, but I've paid myself a salary of $70,000, that means everything beyond that $70,000, I don't have to pay self-employment tax on. Right? That's beautiful. That's 15% of the remainder there. So I keep a lot more money that way. Now, the sweet spot on when to do this is, for me as a business owner, I've got to look at what are my profits as a self-employed person, and are those profits above or below the commensurate pay range for a comparable position in my industry. So again, if that number is 50 grand, if I'm earning less than 50 grand in profits right now, I probably don't need to worry about incorporating yet. Okay, but if I start creeping up over that line, if I've got more than that normal pay range in profits, then I should incorporate, because that's the point in time where I've got excess that I could be paying to myself as a distribution. Okay. Now, if you've got a tax professional, this is something they can help with and strategize on. But that's kind of the basic, timing on when you should go about that. And that's a really good question, Molly. Thank you for asking that. Okay, we have a question here that says, does the tax code allow us to write off all Plexus products purchased for personal use? Good question. So if you're using it for personal use, typically not. Okay, if it's strictly personal use. Now, again, this goes back to living within my business. If it's like vitamins that I am going to use personally, but I'm going to promote that I'm using them, and I'm going to be doing Instagram stories, and I'm really going to leverage the fact that I use these supplements, then I could say this is a product that I'm marketing with, right? But if it's like I bought, a shake or a weight loss product just for my own personal use to get benefit from it, the IRS is not going to let me write that off because it didn't have anything to do with my business. So the key there is, if it's for personal use, I've got to make a better argument that it somehow involves my business, and then I've got to document that. Melody asks, do you like Wave apps? I'm not sure. I've not heard of Wave apps. I'm imagining that's probably another accounting or payroll program. So I'm not familiar with it. I'm not sure what it is, but a lot of these QuickBooks, Zero, if Wave apps is one of them, they're all very similar. So, they will get the job done. It just kind of comes down to user experience and what you prefer. Okay, Stephanie has a question. When traveling, how can I work that with my business? Do I have to specifically be going there for my business, or anything I do business related would count? So this is a beautiful question. People do not realize the benefit of using your business in travel. When you travel, the IRS rule states if you spend more than 4 hours per day on some form of business activity, then you can write off the entire trip, right? So I do this all the time. Every time I go somewhere, I make sure I spend 4 hours a day on my business. Okay, whether that means that I'm prospecting, or I'm marketing, or I'm reading books, or I'm having conversations with my wife, who's my business partner. So technically every family vacation can be a business trip, and I can write that off on my taxes. So that's the way that you go about that. And again, it really comes down to documenting. So make sure you are keeping records, transaction purchases. If you want to log time, you can also journal that and just say, hey, I spent, on my schedule, I spent this much time doing X, Y, and Z. However detailed you'd like to be with that, but that is the key to being able to write off business travel. Molly has a question. If I incorporate, should I be an LLC or a corporation? So that really is a very situational question. So the unfortunate answer there is it depends. Now, a couple of different things that I would look at is, if I do a corporation, like a full-on S corporation, there's a lot more responsibility there. I have to have board meetings. I have to be keeping track of the minutes in the board meetings. And those all have to be available, that if I ever get inspected or audited, I have to be able to show those. If I do an LLC and then just elect to file that LLC as an S corporation, I don't have to do most of those things, right? So there are benefits to doing those things. If I'm a big enough business, I should be having board meetings. I should be keeping track of what happens in those and recording my minutes. So that's a natural fit. But if I'm like not sure, and I don't actually do those things right now, then an LLC that elects to file as an S corp might be a better route. And then I can always upgrade into a full S corporation or even a C corporation down the road. And those are all very situational things. So don't get too caught up in the vernacular and the types of corporations. It really comes down to what's practical for your business. Angela asks, if we haven't become an LLC yet, can we still deduct expenses? Yes, you can. So if you don't have your LLC, you can still write off expenses. Now, again, they're going to be written off as a sole proprietor, which the IRS basically looks as you. You are the sole proprietor. There's no separation there. So if you don't have an LLC, then I would be even more diligent with my record keeping. Okay, like realize you're at risk. If you got audited, there's a higher chance of them saying, no, these expenses don't count. Okay, it's not even fair how much more they pick on sole proprietors. So I would definitely form an LLC just for that fact. And if I don't have one yet, then I'm going to make sure I have really stringent record keeping on every single transaction so that there's no question marks. If I ever got an audit or somebody came looking, I can say, yep, here's all of the information you need to see. And it's irrefutable that that actually did happen. Molly asked, should I do taxes based on SCorp or CCorp status? So if you're doing an SCorp or a CCorp, that is going to have its own form. It's called a Form 1120. Again, we kind of talked a little bit about this. This is more of a situational thing. So there's not a hard and fast answer on which one you would do. It depends on your business and how much you're bringing in and kind of like the ins and outs of how you're running things now. And that'll kind of dictate whether you're doing an SCorp or a CCorp. Melody asked, do my kids have to be a certain age to pay them? Good question. So the kids can be paid. Okay. You can pay your kids with your business. A lot of people don't know this, right? Justin has a large family. Our goal is to pay all of his kids. Okay. And it's through a family management company. So you want to be careful that you're not paying them with your Plexus company. You'd set up a separate company. It's a family management entity. And then that family management entity can be paying them for work. Now, the rule with paying kids is it has to be, again, reasonable. So if I have a 3-year-old and I'm like, yeah, my 3-year-old helps with social media posting, that's probably not going to fly, right? But if I say I have a 3-year-old and I put him in all of my photos, like my Instagram posts and my Facebook posts, and he's a model and we pay him a modeling fee, that is believable. That's real, right? If I've got teenagers and I'm saying, hey, they're helping with shipping, or they're helping with bookkeeping or accounting or filing or managing the client relationship manager tool or whatever it might be, that's believable. So I can pay them. Now, you want to pay them on W-2 from your family management entity. And you want to make sure that you don't pay them more than the standard deduction. So the standard deduction is $12,400. What that means for you is if you were to pay them $12,400, you get to write off $12,400 in expense. They receive $12,400 in income, which is then immediately offset by that standard deduction. So they don't pay any income tax. Now they're your kid, which means you're still their parent and or guardian. And so the money that they're bringing in can go right back into the family budget. So it's not like you have to give them 12 grand and it's theirs, right? You can on paper and via your accounts transfer that to them, and then it can go right back into the household. I would still recommend setting up some kind of savings for them so that there's some benefit to it and they see some exchange there. But that's in a very basic way how you can pay kids. Can you partially write off travel 50-50? So half the time I spend those 4 hours per day, half I don't. So travel, I would just go for the full 4 hours. I would really push for that, whether that's 2 hours before bed where you're reading a book about business and then 2 hours a day where you're promoting and answering emails and whatever else. It's not hard to get to that 4 hour limit. So you probably could partially write the travel off. I would check on your actual circumstances of what you're doing there. But for sure, if it's at least 4 hours a day, then we already do know you can write off the entire trip. So if it's 2 hours now, that's another additional 2 hours well invested to be able to write off the rest of that trip. Question here from Josiah. He says, I'm hiring a bookkeeper for data entry. Do they need to be an employee or can they be an independent contractor? So they could be either or. You can hire them as a contractor. Most people do that. You can also hire them as an employee. Unless you've got a lot going on in your business, usually you don't need to hire a full-time employed bookkeeper. You can hire bookkeepers as contractors via like a monthly or hourly rate, and that's often going to be a lot cheaper than actually bringing on a staff member. A lot less liability too, and a lot less cost. Question here, it says, if my spouse has a different business, not network marketing, do we need multiple LLCs or can they be combined? This is a good question. So the LLC, you got to understand what LLC stands for. LLC stands for Limited Liability Corporation. Okay. So the purpose of an LLC first is to limit liability, right? So if I've got two separate companies, let's say I've got my Plexus business and then my spouse is in a different business. If there's potential liability that could cross in between those, then I should have a separate LLC. Okay. What an LLC does is if somebody were to go after my business legally, it separates my business from anything else, right? So if somebody sues my business and it's in an LLC, they can't also sue me for my personal stuff, right? Or if they sue business A, but business A is in a separate LLC than business B, then those two things are not affiliated. So it gives you a little more protection. So I would recommend if it's different businesses, it's not expensive to set up multiple LLCs. I would definitely go for that just to have that liability protection, but understand that that is the main purpose of it, is to guard against liability. Justin says he hasn't taken a personal trip in over 5 years. That's awesome. That's the way to do it. And then he hires his assistant as an independent contractor and gives her a 1099 as well. Yep. So that's, practical stuff that all of us can be doing. I think that's all of our questions here. So I know we covered a lot here. So what I want to do is, if you guys have more questions, reach out to Justin directly, and Justin can get you connected with us. And if you want to get more information, or you'd like to do a consultation with our team on tax planning or whatever it might be, Justin is the man to go through for that. I'm going to send him a copy of this infographic. So I know you guys have like a Facebook group and probably some different message boards that he can post that on. And so that's an area where he'll put that. And yeah, thank you guys all for tuning in. I know we covered a lot here, so hopefully that was some good conversation.
Yeah, Jerry, thank you so much. I appreciate everybody jumping on. Again, Jerry, that's a really big help for everybody. Again, if you have any questions beyond what you've asked tonight, feel free to reach out to me. I can share with you some of the things that we do. If I don't know, I'll send Jerry yet one more question. I send him some days. Some days I think I might be his only client, it seems like, because I send him so many questions. But he's a wealth of knowledge, and I appreciate him. And I appreciate all you guys jumping on tonight. So this will be recorded. So if anybody you know on your team wants to watch this, or you think it would be helpful to them, let them know. It will be on the team page and on the YouTube channel. Other than that, guys, have a great night. We'll see you later.
All right. Good night, everybody.